Financial Fridays with Dawn. Today we have a great show planned as I come to you each and every week to empower you to live a happier, healthier, and wealthier lifestyle. So earlier this week, I was at one of our industry conferences and I met an amazing guy called Van Miller, who is one of the leading advisors in our field, and he's basically just talking about the truth of what's going on. And you can see it now, everything that's going on in the economy, the stock market's doing well, and we're going to tell you the reasons why all this is happening. There's like kind of stuff going on that most people aren't aware of, or because they're just not aware of it. So I just want to make you aware of some interesting facts that I learned. So I'm going to be reading all this because there is a lot of stuff and I don't want to miss anything. So and all this information could be found at the US Debt Clock, which also is on my website, dsfinancialstrategies.com, and also the Truth in Accounting website. So first of all, let's just explain why the market has done so well. Some of you are probably aware it's because we are printing money. And when you print money, that increases the liquidity, which has bumped up the stock market as it has for the past decade. So how much longer can we go on printing money? So let's see here. So basically in the year 2000, the money supply was only $4.7 trillion. As I say, only 4.7 trillion. But the current money supply is over 14 trillion. So, and it came from printing money. And that's banks now too. They had to bail out the banks, so they printed more money. So the Federal Reserve Bank now, their balance sheet went from 400 billion to almost 5 trillion. So this is unsustainable. You can't just keep kicking the can down the road and just think everything's going to be hunky-dory. So now what else happened when we started printing money? Well, other countries started doing it. China, Japan, South America, Europe, and you can see what's going on with Turkey and all that kind of crisis and craziness. So that's why our stock market is propped up. A lot of people say it's Trump. There's all different, I don't want to get political or anything. I try to stay out of politics and don't really pay attention to that because it's all just negativity, and you can find out what the truth is really going on. They want to kind of just like make you think it's one thing when it's actually another. But as it relates to your money, I'm here to tell you the truth and how we can prepare for this. And also, this is another scary fact too. 64 out of the 75 largest cities in the U.S. cannot pay their bills. And this amounts to $335.4 billion. Now, the states aren't like the Federal Reserve, so they can't just print money. So all those promises that they promised us with like the state pensions and all that, who knows where that money's going to come from? So that might not even be there, or at least part of it. You might even have to start paying for your own health benefits, teachers and federal employees who were promised these benefits. And healthcare, that's an unfunded liability of $423 billion. But we'll get to that later. So here's what else it says. As a country, we take in 20 trillion GDP, but we have 20.6 trillion of debt. So we have much more debt than we are when we're even taking in. And so the government, their budget was 4 trillion, I'm sorry. And there's, now they increased it to 4.4 trillion. And we only take in 3.3 trillion in taxes. We are spending way more than we make. So obviously this is going to be a problem. So now our total debt of all of us combined, the US citizens, take a guess. It's $69.4 trillion, almost $70 trillion. The majority is student loan debt is $1.5 trillion. So we can see that's going to probably be a bubble that's going to come to a head eventually. Credit card debts, people are just spending way too much money. That's $1 trillion of debt. And Social Security, that's where a lot of our unfunded liability is. That's $17 trillion. And Medicare's unfunded liability is $26 trillion. So let's get back to the budget, about that $4 trillion that we have that comes in. No, that they have a budget for, I'm sorry. Now it goes to these 7 things: Medicare, Medicaid, Social Security, Defense and the Housing, Homeland Security, income, security, interest on debt, and the federal pensions. So now we spend more than $1.5 trillion than we take in on these programs. So now let's talk about how many people there are. So there's 327 million people in the U.S. Now only 121 of them are actually paying taxes. 52 million are receiving Social Security benefits. So think about that now. That's 2.3 taxpayers for every one person receiving a benefit. Now that was not supposed to happen until 2030. We're only in 2018. So can you see Do you think this might be a problem going further? Like, where are they going to get this money from? I think I read a statistic somewhere that they would have to permanently increase the tax rates on everyone by 2/3 permanently, or reduce everything by 40%. They're not going to happen, especially now when in the next 26 years, between the Generation X's and the current baby boomers, there's going to be 104 million people on Social Security. How is that going to be paid for? You know how it's going to be paid for? It's going to be paid for by you, the taxpayer, people who are working hard, and now we're going to have to help pay for everything else here. There's some more statistics. 57 million people receive Medicare benefits. So now that's 2.1 taxpayers for every recipient. 75 million people are on Medicaid. That's almost 1 in 4 people in America. That's huge. That's a lot of people. So the total number of people receiving these Medicaid benefits is over 165 million. That's 35 million more people than there are taxpayers. And I also read a statistic somewhere too that Ben was telling us, I believe, so hopefully I don't quote this wrong, that there is only 90% of the people in retirement only have $104,000 balance in their retirement plans. So that means there's like 10% of people that are going to be paying all these taxes. So what I want to do is show you how to reduce all your tax liability. Because if you followed what the government wanted you to do, what Wall Street wanted you to do, what the banks wanted you to do, what they're telling you to do is put all your money in your 401k plans and IRAs and everything is going to be great. Well, let me tell you, where are they going to get tax money? You're going to pay taxes on that money when you take it out. And most of you, I know all of you know that you're going to have to pay taxes, but there are some people I've run across that think that they're just going to take out that money and it's going to be theirs. No, you have a silent partner, which is the government, and the Internal Revenue Service. They determine how much taxes they need, when they need it, and they're coming for you because you have these balances, the 10% that we're saving them. Let me see if there's any other statistics I want to kind of go over here. So we won't go into that. So now I want to talk about how can we solve this problem. Very easily, we can reduce our taxes on our retirement account to under 20%. I'm going to show you how. And again, there's a lot of math here, so let me get into it. So let's just we're going to talk about a married couple, and we're not going to talk about Social Security now, because I don't want to get too crazy with all the numbers. Maybe we'll do that in a later episode. So now with the new tax law, there is no personal exemption, and the standard deduction was increased to $13,300 for single people. So double that, $26,600 for a married couple. So you know what that means? That means you can withdraw $532,000 that was taxable money without ever paying taxes on it. That's huge. No income tax on fully taxable withdrawals. So, and that's just the standard deduction. So that was a great thing. And actually everyone can benefit from these new 2018 tax laws because everyone's income is reduced. I mean, their brackets are reduced. So there's obviously a 0% tax bracket, a 10% bracket, a 12%, 22%, and 24%, and then obviously up above there. But today I'm going to talk about just people basically under that bracket. So here we go. So now, so you get that $532,000 over 20 years if you withdrew the $26,600 from your IRAs or 401k plans. So now that would come out tax-free to you. So then you could take, then the next $19,000 is only taxed at 10%. So now we can withdraw $45,650 for the next 20 years. And so now that's 10%, but the effective rate, now marginal rate is what your income is. The effective tax rate is what you're actually paying taxes on. So that is only 4.1% that you're paying off of 10%. So over 20 years, withdrawing the $45,560 is $913,000 that you withdrew at only a 4.1% tax liability. So you only had to pay $37,433 to pull out $1,913,000 that was going to be fully taxable. That's a great benefit. But no, wait, it gets even better because now when the next $58,350 that you take out is only taxed at the 12% tax bracket. So that would be, now you could take out $104,000 of fully taxable money every single year. And for the next 20 years, that's about $2 million. And you would only pay 8.6% on that $2 million, or $178,880, to get rid of those taxes forever. For you, your heirs, it's amazing. So basically your heirs, because they're going to be the ones that are going to end up with these big, huge IRAs that the 10% did save, and there's no way to transfer it. Normally, if they follow the rule, they're going to get hit with a big tax bill. And I'm going to try to eliminate that for people and do it while you're alive. So, and then the next, so actually, you know what, let me just break this down, make it even simpler, because I know I'm probably boring you with all these numbers. So in the 12% tax bracket we talked about, you take away $2 million and your effective tax rate is 8.6 and you only pay $178,000. So now, once you jump up into the 22% tax bracket, that next money on top of that, you're only paying $563,000 to pull out $3.8 million. And that's only a 14.7% tax effective tax rate. So think about that. $3.8 million that was fully taxable, you only had to pay a little over $500,000 to get that money out. This is amazing. And now here, if you're at the 24 tax bracket, the next you could pay only $1.24 million to eliminate taxes on $6.8 million over 20 years. And that effective tax rate is only 18.8%. So this is the magic of our progressive tax law system that we have here. So again, to summarize, I want to help you take control of your income tax liability, because as we saw at all those statistics, we are in a huge mess and nobody wants to talk about it. They'd rather talk about what Trump's tweeting for the day instead of what's really going on with the economy and how it's going to impact us. And it's going to impact us with our money and the money that we're saving, that we think we're doing a good job with saving all this money. But now I'm here to show you how you're going to get that money out, because everybody's good at accumulating, but no one tells you how to get the money out and how to reduce those taxes. So, because I'm sure there's somebody more than anyone than you love than just the person at the IRS. I'm sure you don't love that person. So why give them your money? Give it to your family. Give it to charity. Give it to anybody but the government, because obviously they can't even spend the money right, as we could see in the statistics here. And eventually they're not going to be able to print enough money. It's just going to cause more inflation and then lead to deflation of your personal accounts, so and so on. So now, but when you take this money out if you want to plan for future generations to make it tax free, you got to put it in places where it's tax free. And life insurance is one of those greatest things. And I like to tell people, because most people, when they hear the word life insurance, they kind of shut down. But life insurance has so many great benefits. So I just ask you to keep an open mind, because most people are going to love it, but they hate the name life insurance. But that's what it is. And again, nobody wants you to know about this, because why? Because one of the benefits is it's tax free. And how is the government going to get their money if it's inside of vehicles that are tax free? They're not. So that's why they promote all these other vehicles, which I've told you before in other videos. So what's great about another benefit of life insurance, it's creditor protected. It comes out tax free. There's no probate. It's private. You could, it helps Medicaid versatility, because again, a lot of your money could go to the nursing home. So it helps with that. So these were just ways that we could help eliminate taxes on our money. So now, how about you single people out there? Again, for someone who's like over 65, like I said, your personal exemption is $13,300, $600. I'm sorry, I quoted the wrong number. So $13,600. So 0% for that first amount, and then the next $9,525 you earn is at the 10% bracket, which is effective rate, as we heard before, is only 4.1%. So, and again, so basically just to summarize it, because I know I'm probably boring you with all these numbers, but if you want the math, email me and I will give you all the math. And so basically, here's a rule. It's the rule 104.12. So basically, married couples, you can earn under $104,000 and only be in the 12% tax bracket. For singles, you half that. So $54,000 you can make under that, and you're in the 12% tax bracket. So it's better to have more of your money than giving it away to the government and the Wall Street and all that. So I hope this just kind of was helpful in showing you how to reduce your tax liability when you have all this money in IRAs. So when you get to retirement. So I know this might not be pertinent to you, but your parents, it could help them, because, and then ultimately, you're going to be the one that's going to be left with the money. So if you could have a conversation with your parents and talk to me, we can reposition the assets so you benefit, they benefit, and then also the younger people who are putting more money into their 401ks in the company match. I'd love to sit down and have a conversation with you so we could have all our money tax-free and not have to worry about doing all this down the road. So, because there's things you could do now to plan. And also, here's another question I'd like to ask you. What if you could totally eliminate any downturns in your life for the market, any money that you have in the market? What if we could just eliminate those? How would that drastically change your life? Not having any ups and no downs, you're just going to go up. And that's what I could show you to do. And then even better, because even if you don't lose any money, that's not good enough, because you have to be able to actually make money to have a secure financial future. So what if when we have those downturns, you could take money from where you have a place that you're never going to lose it and go take advantage of the upswing, because usually, typically after a downturn in the market, it pops up again and you can take advantage of that. So because the whole buy and hold doesn't work. So this is a way you could do that, and I'd love to show you how you could take advantage of the next downturn and not lose money, as a lot of people did in 08. A lot of my clients, if they were in the market, they lost a little bit, but if they were in the products where we never had anything, they actually made money. So I'd love to have a conversation with all of you. So reach out to me, my website, www.dsfinancialstrategies.com. Call me, 215-660-0288. And I hope you all have a great weekend, and I continue to empower you to live a happier, healthier, and wealthier lifestyle. Have a great day.